All right. Well, thank you for joining us, everyone. We're going to be chatting about the Wall Street speculation tax. We have a number of presenters on the line with us today to go through a number of things, and I'm going to hand it over to Jim Lardner, who is the Communications Director for Americans for Financial Reform.
Thank you, Dave. Can you all hear me?
I believe we can, yes.
Great. Welcome. The subject of today's webinar is the policy proposal known as a Wall Street speculation tax or a financial transaction tax or FTT. Our purpose is to spell out the main arguments for such a tax, why we strongly believe it should have a place in the current Washington debate about budget policy and economic recovery as well as financial reform. And ideally, we will come away with some understanding of and ability to respond to the distorted claims made by the financial sector opponents of an FTT. We've been hearing more from those opponents lately, which suggests that they've started to worry about an idea they have felt free to ignore until recently. That should encourage us. We have 4 presenters who will speak for 5 minutes each in the order in which I will introduce them now. Dean Baker first. He is an economist, a frequent commentator on the NewsHour and other programs, and co-founder and co-director of the Center for Economic and Policy Research. He was an early and insistent warning voice against the excesses that led to the financial crisis of 2008 and the ongoing economic calamity. David Borris is the owner of a catering business on the North Shore of Chicago who has been deeply involved in state and local issues on behalf of Illinois small businesses. He is also one of the leaders of the Main Street Alliance, which advances public policies that are good for small businesses and their employees and communities. He has testified before Congress on health care and financial reform. Damon Silvers is Director of Policy and Special Counsel for the AFL-CIO. He serves on the Office of Financial Research's Financial Research Advisory Committee, a body devoted to assessing systemic risk in the financial system. Also on the Securities and Exchange Commission's Investor Advisory Committee, the Standing Advisory Group of the PCAOB, and he was Vice Chair of the Congressional Oversight Panel for the TARP program in the aftermath of the financial crisis. Finally, Ben Jones, the former Green Jobs Advisor to the Obama White House, is an author, a CNN contributor, and the president and co-founder of Rebuild the Dream, a platform for bottom-up, people-powered innovations to help fix the U.S. economy. So first up is Dean Baker. Dean, are you with us? Are you unmuted?
Hello?
Yes.
Okay, sorry, I just muted myself when I went to unmute myself. Okay, thanks, Jim, for the introduction, and I appreciate the chance to talk, and I see we have a lot of people on here, so it's great to have a chance to raise this issue, and I hope we can make it more front and center in the debate. Okay, can we get the next slide? All right, I want to make 3 main points. First off, that there's a lot of revenue potentially at stake here. We have a lot of debates in this town in Washington that oftentimes end up not being over very much money. And the point I want to make here is that in this case, when we're talking about a Wall Street speculation tax, sales tax, whatever we want to call it, there is a lot of money at stake, and I'll make that point. Secondly, this money is going to come almost entirely out of the pockets of the financial industry. So this is not a case where we're talking about hitting middle America. As I'll point out, you know, we're going to see most of the money. It's not coming from pension funds or 401ks, although I can't say everyone's going to be left entirely whole. This is something that comes out of the pockets of people who should get hit, out of the pockets of Wall Street. The third point is that it's likely to lead to more stable markets. We've had a lot of instability in financial markets recently. I can't say that we'll eliminate that entirely, but I think reducing the volume of trading and reducing a lot of the high-frequency trading, a lot of the very, very short-term trading that we see in financial markets will make them more stable. Okay, next slide. Okay, just this is comparing the amount of revenue that could be raised through a financial transactions tax, and here we have a specific proposal. This is a tax of 3/100ths of 1% on all financial transactions, stock trades, options, derivatives of different types, credit default swaps, that was put forward by Senator Tom Harkin in the Senate and Peter DeFazio in the House. And this was actually scored by the Joint Tax Committee of Congress. So that's where that number's coming from. That's their estimate of what this tax would raise over 9 years. And they did a 9-year estimate because they assumed it would take a year to be up and running. And what I have here is I'm just compared this to some of the other items that we've heard debated in the last couple years or so. So the Buffett rule, the requirement that billionaires pay at least as much, high percent on their tax as Warren Buffett's secretary. That would raise $39 billion. That's an estimate from the Congressional Budget Office over the same period. So we're looking at $352 billion. There's $39 billion. Carried interest loophole, very good policy. Why give hedge fund managers, people like Mitt Romney, special treatment on their income? That would raise about $13 billion over this 9-year period. The bank tax that was proposed by the Obama administration, I don't know if anyone will remember that, but that would raise about $61 billion. Again, not a bad proposal, but just, again, give you a sense of the order of magnitude. Oil and gas and coal subsidies that the Obama administration has tried to eliminate, that would raise about $28 billion over this 9-year period. So we're talking about a very modest tax. This is 3/100ths of 1%, and it could raise on the order of 5 to 10 times as much as these other items that we've had in public debate. So we are talking about real money here, and I'll just make another point. This is actually a relatively low tax. There are other proposals out there that would raise even more revenue. So it's not as though that's the most that could possibly be raised. There's a proposal that the European unions could see very seriously that would have a 1/10 of 1% tax on stock transactions that if you had a comparable tax in the United States would raise even more revenue. Point is there's a lot of money here potentially. This is not a small item. Okay, next slide. Okay, one of the main reasons why I think a tax like this is so important is that we've got literally an explosion in the size of the financial sector over the last 4 decades. And what I've done here is I've shown, here's the proportion. If the financial sector, and this is the narrow financial sector, I'll explain in a second, if we're the same size today relative to the economy as it was back in 1970, it'd be a bit over $60 billion. Instead, it's about $275 billion. When I'm saying the narrow financial sector, I'm not talking about the banks where we're going to with our checking account or savings account or have our mortgage. I'm saying narrow financial sector refers, at least as I have in this slide, this is investment banking, commodity trading, securities trading. This is sort of pure financial activity. These are people who are issuing credit default swaps. People who are flipping back and forth options, different types of securities, coming up with complex derivative instruments. That's the financial sector I'm talking about here. And that's exploded. It's more than 4 times as large as a share of the economy in 2012. And again, I'm saying as a share of the economy. So I'm not just saying it grew with the economy. It grew much more rapidly. Now, the other point to make about this is this money comes from us. Okay, they're getting that $274.9 billion from us. It's not manna from heaven. They're getting it from the rest of us. They're getting it from the fees they charge us on our 401ks, the fees they charge us on pension funds, the fees they charge when we buy and sell stock or other assets. That's where that money's coming from. They're getting that out of our pockets. So they're getting an awful lot of money out of our pockets. And again, this is every year. So, you know, people watching like to talk about 10-year budget windows. Just multiply that by 10 to just get an idea. We're talking about somewhere in the close to $3 trillion. It's real money. Okay, next slide. Okay, so question is how much impact will this have on, say, you know, us with our 401ks? You could think of if you want to put pension funds in here, whatever, you know, the type of trading that normal people do. And here I just said, imagine we have a $100,000 401k, and let's imagine that we turn over half, $50,000 a year, and we're paying the 3/100% tax that would be put in place by the Harkin-DeFazio tax. Now, the first bar, these are very hard to see because this is very small relative to $100,000. That shows the cost of trading. The cost of trading we'd have now if we assume that we could trade our stock at a round trip of 0.3%. So those are the fees that they charge us now. That's probably a little low. I'm assuming a low low to make it more favorable to Wall Street. So I'm assuming they just charge us 0.3%. They might charge us 0.5, might even charge us 0.6. It depends on the scenario. But in any case, I'm making it favorable to Wall Street. So then I say, okay, well, suppose instead we have our tax, hearken to FASIO passes, President Obama signs into law, so we're now paying a 0.03% tax on our trades. Okay, each trade is going to cost us more. There's a lot of research on this, and what it shows is that when trades cost more, people trade less. That shouldn't surprise anyone. In general, when price of something goes up, you use it less, you buy less. Same thing with trading. So the story here is I'm saying, okay, let's say we increased trading costs by 10%. They went from 0.3% to 0.33% because of this tax. We reduced our trading volume. Instead of flipping over half of our portfolio every year, we only flip over 45%. Well, what happens in this case? Well, we're actually spending less on trading. We're going to be paying the tax, but because we're trading less, our total trading costs will actually have fallen slightly. Now, I'm not going to say that's exactly what's going to happen, but that's going to be somewhere in the ballpark. So in other words, we're likely to spend less, maybe a little more, whatever it might be. We're going to see very little change in our trading costs. What happens here is this comes at the expense of Wall Street, which, to my mind is just fine. Now, one last point I want to make on this. I realize I'm going a little long here. One last point I want to make on this. I know everyone, when they trade, they think they're making money, and I'm sure some people are. But the reality is we don't all make money by trading. So in other words, if one of you is really smart out there and you know when to sell your stock or when to buy in or whatever, you have some sucker like me that's losing. And on average, that's the way the world works. We're not making money by trading. So some people will get luckier, they're smart, or whatever you want to say. They will make money, but others are losing. On aggregate, that's basically a zero-sum gain. So if we're trading less, odds are our portfolio is going to do the exact same thing on average. I mean, sometimes we might have made a really good trade, but other times we would have made a really bad trade. So on average, we're not going to be making less money if 45% of our portfolio flips over every year rather than 50%. And, that's a pretty safe bet. So the long and short of the story is that the cost of the tax is going to come out of Wall Street, which to my view is exactly what we would want to see. Okay, next slide. Okay, the last point, can we reduce volatility in financial markets? And I don't want to carry this too far. I'm not going to say that we're not going to have any bubbles, we're not going to have any volatility, but we can point to some instances where we had extreme volatility literally driven by nothing. When I mean driven by nothing, this wasn't something in the economy. This was just events that happened in the financial markets and were perpetuated by a system where you had these very rapid turnover, very computer-driven, high-speed trading. And the two that I've listed here, the flash crash back in 2010, the stock market fell by 9% based on nothing. I mean, there's nothing, we didn't have bad news that, the economy had gone back into recession. I mean, nothing worse than we've been seeing, at least. There was nothing that day that led the market to fall by 1,000 points. And, of course, it bounced right back. Problem, of course, was if for whatever reason, you had to get out of the market, you just took a 9% hit on your portfolio. If something bad had happened, you suddenly needed to cash out. You just took a 9% hit over nothing. This is all computer-driven trading that had no justification in terms of the fundamentals of the market. The other famous incident like this was back in 1987, where we had Black Monday. The United States had this, but it was markets around the world plummeted by more than 20%. Again, based on nothing. This has been heavily researched at this point. It's a quarter century in the past. No one could identify any event in the world. And, of course, the markets eventually recovered. But this was, again, a case where you had computer-driven trading that pushed the market down, in a very, very rapid pace. And, again, if you had to sell, if you had to get out of the market during that period, you took a very big hit. Now, putting a tax of 0.03%, is that going to stop that? I can't say it will. I think it makes it less likely. That's the best story I think we could tell. Reduce the volume of trading. We know that for certain. You make a lot of the high-speed trading, high-frequency trading that we see today, you make that unprofitable. If you're looking to, buy and hold shares of stock, you want to buy IBM stock and use that as a fund for your kids' college education, whatever it be, you're going to hold it for years. You're not going to care. You're not going to notice the 0.03%. But if you're buying every second, buying and selling every second of the day, you're going to notice that. That's going to very much discourage you. And I would argue that's likely to prevent at least some of these incidents. It's not going to make the markets foolproof. It's not going to prevent any sort of erratic movements at every bubble, but I'd say it makes it somewhat less likely. Okay, last slide. Okay, well, just to sum up, I think this is a very good way to raise lots of money. We know this is an economy that's very rich, and, you know, it makes sense. You know, the old line about Willie Hutton, you know, why do you rob banks? Because that's where the money was. Well, this is where the money is. It's on Wall Street, and, you know, we all recognize we need the financial sector. It serves a productive purpose, but it's gone way beyond that. It's very bloated. This is a way to bring it back down to size, and in the process get a lot of money that we could use for productive purposes. So sorry I ran a little long. I'll shut up here. Thanks.
Thanks, Dean. I want to take a second to caution people to put their phones on mute and not to use the hold function. We've been hearing some background noise. And now I will turn it over to David BORRIS, our next speaker. David?
Yep. Are you waiting for me?
Yes, sir.
All right. Thank you. So good afternoon, and thanks everybody for the opportunity to join today and to bring a brick-and-mortar small business perspective to this conversation. I've been a small business owner for over 27 years. My wife and I opened our business in 1985 with a few of our mom's favorite recipes, a catchy idea for a name, Hell's Kitchen Catering. We named it after my mom, Helen. And a work ethic that often saw us starting at 6 o'clock in the morning and finally locking up by about 9 or 10 p.m. It was difficult, but it was good work, and so we launched a little homemade food store. People liked what we offered, and we began to expand to serve the demand of our growing customer base, and finally developed the concept into a full-service catering company that now employs 27 full-time employees and a little over 80 part-time and seasonal workers every year. The whole team really takes tremendous pride in what we do, which is serving the neighborhood, the local community, and creating jobs in our local economy. But since the onset of the financial crisis in 2008, small businesses all across the country have faced a double squeeze. On the one hand, customer demand vanished into thin air. At Hell's Kitchen, we're just now in 2012 and 2013 getting back to the top-line revenue numbers that we were hitting in 2008 before the crash. Main Street small businesses all over the country saw local economies and customer bases decimated. Between March of 2008 and March of 2009, small business bankruptcies nearly doubled. At the same time, access to credit dried up for many small businesses. We've been fortunate over here to be able to grow our business without outside financing for years now, but many small businesses, and especially young startups, are not in that position and need capital to launch or grow, but they couldn't get it because of the frozen credit markets. So customers and credit, together these two things really make up the lifeblood of brick-and-mortar small business success, and since 2008, they've sort of been missing in action. So it's precisely why I think a financial transactions tax is a good idea and is needed right now, because it can help small businesses on both sides of this equation. So let's start with the customer side. How can the FTT help with the problem of weak demand in local economies? So looking at slightly more big picture, what it'll do is provide an alternative to the downward spiral of austerity economics. So much of the talk in Congress for the last several years has been about cuts, but we can't cut our way to prosperity. Europe tried austerity, and how's it really working out for them? As an entrepreneurial small business owner, it's obvious to me that cuts and austerity are not a long-term strategy for growth, not for my business, and certainly not for the nation's economy. Small businesses like mine need customers, not more tax cuts, not more budget cuts. The way to rebuild our local economies is to invest in infrastructure, invest in local jobs that bring paying customers into our Main Street businesses. The way to stagnate those same economies is to further cut budgets and further create conditions that undermine core infrastructure and basic services like education, job training in emerging industries, and law enforcement. These sorts of misguided austerity simply act to further reduce demand in local economies. To build and grow for the future, we need to get back to a national conversation about investment, not austerity. And investment requires revenue. and the current revenue stream of taxes flowing to the federal government stands at its lowest as a percentage of total national output, lowest level since the end of World War II. And the FTT will put real revenue on the table. On the other side of the equation, not only is a financial transactions tax a way to raise revenue, but it's a way to do it that promotes productive long-term investment, exactly what we need to encourage capital formation for small businesses. Wall Street and the financial markets have always had a critical role to play in capital formation for small and startup businesses. But over the past several years, we've seen Wall Street and the bigger banks drift away from this role. The explosion of high-speed frequency trading and the growing focus on proprietary trading have resulted in a declining focus on traditional, long-term, economically productive investment. It's been bad news for small business lending. Capital markets should facilitate investment in emerging and growing businesses, not be a forum for high-speed casino gambling. For the health of the brick-and-mortar economy, we need to turn that around. A financial transactions tax will help do that by raising the cost of speculative activities in the financial sector while barely touching traditional investors in small businesses like mine. So how will a financial transactions tax impact small businesses, brick-and-mortar small businesses like Hell's Kitchen? The impact on me, my employees, and my business will be negligible. My average employee's annual contribution to their simple IRA, that's our retirement vehicle for small businesses, like a 401k, is between $3,000 and $4,000, making a 3 basis point FTT cost about $1. That's right, about 90 cents to $1.20 annually. That's not quite 10 cents a month. So even for myself and my wife, who are able to contribute considerably more, the cost will be a little less than $10 a year, maybe about 80 cents a month. And since the tax is collected by and paid for by the trading firms that hold our portfolios, there will be absolutely no additional paperwork to my staff. So taken all together, it's obvious that the minuscule dollars to businesses like mine associated with an FTT, like Harkin DeFazio or Allison is talking about, is more than worth the cost of a better functioning financial system that works for everyone, not just a select few. A financial transaction tax is an opportunity to raise revenue, reverse the focus on what is good for Wall Street back to what is good for Main Street, and level the playing field for small businesses all at the same time. It's a good idea. Now's the right time and place. Thank you.
Thank you, David. I want to remind people you can send your questions as soon as you think of them to Marvin Silver, one of the names listed above the notes function on the lower right of your screen. And now, next up is Damon Silvers, Director of Policy and Special Counsel for the AFL-CIO. Damon?
Thank you. Can you hear me?
Yes.
Good. All right. I've been asked to cover a number of sort of different subjects here in 5 minutes. So let me begin with the question of, as I think we began this session with, is this really happening? And the answer clearly is yes, meaning that the European Union is clearly moving forward with a financial transactions tax. The dimensions of it are being negotiated, so it's clearly going to happen in Europe, which is partly why you've seen some more vocal opposition in this country. Secondly, a financial transactions tax or Wall Street speculation tax is a key policy objective of the global labor movement, not just the labor movement in the United States, but the labor movement all around the world, and was a focus of the labor, and it has been a focus of the labor movement's efforts to engage with the G20 over the last several sessions, particularly at the Cannes session, where the United States government made clear that it was not in principle opposed to a financial speculation tax. Now, the second point I've been asked to make is why is this fundamentally a fair public policy? And there are really two reasons why it's a fair public policy, in addition to a very effective raiser of revenue, as Dean has explained. The first reason is that, as David was talking about, we continue to be in a public policy environment dominated by the notion that we have to reduce deficits. Now, whether that's a good idea or not, that's definitely what they're talking about here in Washington. And what's actually happening to reduce deficits are things like cutting back on money to put little kids through Head Start, like threatening Social Security, like threatening Medicare. And against the background of these things, it's frankly unethical not to consider a tax whose fiscal impact is double some of the measures I just described. For example, I think people may be familiar with the fact that the AFL-CIO is strongly opposed cutting the cost of living adjustment in Social Security through a device somewhat misleadingly referred to as chain CPI. Well, chain CPI and its entire effect on the federal government, not just on Social Security, is less than half of the measured impact, according to the Joint Tax Committee, of the more modest version of the Wall Street speculation tax, the Harkin-DeFazio bill, which has been priced by Joint Tax at over $350 billion over the 10-year budget window. Now, so the first reason why this is fair is because, as the other speakers have pointed out, right, it raises revenue from people engaged in high-frequency trading, which is not the same thing as investment. In terms of its impact on the economy, it's far less contractionary than most other revenue devices. And it's a viable alternative in its scale to, frankly, almost everything that is currently having a socially negative impact. But there's a second reason, and it's one that's been relatively little reported on, as to why there's a compelling case in terms of basic fairness for Wall Street speculation tax. And that is that most American households have really only two meaningful assets, which are their home and their car. Right? In a time in our country where the median African American and the median Latino household have net worths of under $10,000, right, it's clear that for many American households, a car is the only asset of any kind they actually own. Financial assets of the kind that would be affected by the Wall Street speculation tax are held pretty much exclusively by the top half of the income structure, and the vast majority of financial assets are held by the top 20% of the income structure. And here's the thing about this: if you transact in the assets that most American families hold, cars and houses, you pay large transaction taxes. Not a third of a basis, not 3 basis points, not 0.03%, right? But 3% and 5%, as anyone who has bought or sold a house or a car who knows full well. In fact, financial assets of the kind we are discussing are the only types of capital assets in our society that we do not pay transaction taxes on. And perhaps not coincidentally, they're overwhelmingly held by the most affluent and the most privileged people in our society. Now, the final point I'm going to make here is why some of the arguments that have been made against the financial transactions tax are either wrong, misguided, or frankly dishonest. The first I'll start with is the assertion that I gather has been made in some conservative blogs that a Wall Street speculation tax would involve taxing people's checking accounts and taxing people when they went to the ATM or used a credit card. And this is simply not true. There is no proposal currently being considered in the United States Congress or by any of the people on the phone on this call that would affect normal consumer financial transactions of that type. The second objection that's been raised is that a Wall Street speculation tax would reduce liquidity in our capital markets. And it is true that it would reduce a certain type of liquidity, which is the liquidity provided by high-frequency traders operating on whose business operations assume the existence of liquidity in the markets. It would have relatively little effect in the minds of most experts on the availability of liquidity when you actually need it. And in fact, as Dean kind of suggested, a financial speculation tax would dampen the sorts of volatility that tends to produce genuine liquidity crises. Third, arguments have been made that a Wall Street speculation tax would be subject to leakage, meaning that people would not pay it, meaning that people transact in financial markets would simply evade the tax. This is an absurd argument in light of the fact that unlike, for example, sales taxes, which are levied on cash transactions, a Wall Street speculation tax is levied pretty much exclusively on transactions that by their very nature run through clearinghouses and exchanges and have as one or more of the two counterparties highly regulated banking institutions. Assuming that the Wall Street speculation tax is not actually designed to fail, it should be much more easily policed than most of the taxes that we collect in our society today, like sales taxes and income taxes. And finally, the final argument is the argument that should the United States adopt a Wall Street speculation tax, that it would lead to the flight of financial activity to other countries. At the moment, it seems more likely that the European Union will adopt these Wall Street speculation tax first. That seems, given that the major financial centers that the United States is currently competing with that don't have a financial speculation tax are in Europe, because the major Asian markets, Hong Kong and Shanghai, do have. It seems rather unlikely that this will happen. In addition, both the revenue estimates we've seen both in Europe and the United States for a financial speculation tax do not assume that there would be no leakage. In fact, they take that into account. And so you can see that even with, frankly, conservative, meaning skeptical estimates of market leakage as a result of a financial speculation tax, the Joint Tax Committee still has found that in its modest form, it would raise over $350 billion over the 10-year budget window, more than half the amount of money needed, for example, to meet President Obama's revenue targets in the current fiscal negotiations. And so I will stop with that, and of course, I'm free to answer questions.
Thank you, Damon. And I remind you all to email your questions to Marvin Silver. We already have several lined up. Thank you very much. And now to our final speaker, Van Jones of Rebuild the Dream. Van?
Hello. First of all, thank you for putting the call together. Thank all of you for being on. I just want to make a few points, and then we'll move to the questions and answers. First of all, I represent an organization that has about 500,000 members across the country. We're in every congressional district. We have 80 partners that we launched with about two years ago. And at that time, when we launched, we went through a process with 131,000 Americans to come up with an agenda to figure out what might be done to get America's economy back on track. And far and away, the most popular idea that emerged was this idea 2 years ago. And it's because it makes basic sense to ordinary people that if we have to pay sales tax on our cars and our houses and on winter coats for our kids and for things that we need and that we're investing in, that the people on Wall Street should do the same thing. And people are actually shocked when they realize that these thousands of trades that are happening every second, there's no tax on them. The only place this idea is controversial is in Washington, D.C., where Wall Street lobbyists kind of occupy the place. But this is a very common sense idea. It's why it's sweeping the world. It's also important to recognize that this is an idea whose time has come because the idea of austerity is over. That idea, which was tried in Europe and failed so miserably, that idea is dead. It just hasn't been replaced by anything. This is the idea that is the only actual alternative to some version of austerity. And so I'm very, very proud to be a part of this phone call. You're going to be hearing about this idea more and more because when you do the math and you run the numbers, we don't have another alternative. Wall Street is going to have to pay its fair share in order for America to get back on its feet. To the point about fairness, equity, I just want to underscore some of Mr. Silver's points. We do have a situation in which African Americans, Latinos, low-income Americans really were pummeled in the last financial crash. And I think all of us would think pretty poorly of a person who had a big party at a hotel, ran up a big bill, trashed the place, and then sent the bill to his neighbor. That's essentially what Wall Street did. They had a big party at everybody's expense, trashed the place, and essentially they want to leave the bill to the rest of us to figure out how it is we're going to pay for the damage. Well, Wall Street should actually be a part of the solution. And African American Latinos in particular were really hurt in the last crisis in terms of loss of wealth. Depending on the numbers you look at, between 50 to 80% of all African American wealth was wiped out in a 2-year period because we were overly participating in the housing market. And yet we haven't been able to enjoy the gains that have happened with the stock market going back up because we underparticipated there. We can look at the causes for that historically, but at the end of the day, the people who have suffered the most in this past crisis, low-income people, working-class folks, rural folks, should not be expected to now pay the cost in terms of austerity by losing out even more now when it comes to cutting back on middle-class programs like Social Security, Medicare, cutting back on scholarships, cutting back on roads and bridges being constructed in their neighborhoods, cutting back. The communities that suffered the most and have not yet to recover, it should not be on the chopping block. This idea of a grand bargain that actually asks the people who've already benefited the least and are suffering the most to suffer more is a misnomer. There's nothing grand about that. A grand bargain would be a bargain in which the people who actually had the party, enjoyed the benefit, and are now doing fine again, actually come back to the table and say, how can we help our country? What can we do now to help the country that helped us? America bailed Wall Street out when Wall Street was flat on its back. Wall Street's standing up again, and Wall Street should be proud to come to the table and contribute a little bit back to the country that rescued it, now that there are communities all across the country that need rescuing. And so that's what this is about. It's just at a basic moral, ethical framework. It's very hard to look in the eyes of ordinary people whose kids are graduating off a cliff into the worst economy since the Great Depression with $20,000 in debt, $80,000 in debt, and no job. Explain to them why Wall Street shouldn't pay any sales tax that might actually be able to put some scholarships back in these communities, put some roads and bridges back together, invest in basic R&D, and create an economic future for their kids. It is very, very difficult to look in the eyes of people in rural America who are watching their communities being devastated economically because we have not seen the kind of economic recovery in the heartland that we deserve. To explain why big folks on Wall Street should be able to have 1,000 trades a second and pay no sales tax. Well, they have to pay sales tax when they go to Walmart. This is just a basic fairness question. This is an idea whose time has come, and it is the main proposal that will reset the debate on the alternative to austerity and what a real grand bargain will look like.
Thank you. Thank you all. The subject of today's webinar is the substance of the issue rather than the politics, but we will have here's the slide. This is about asking questions, right. You ask questions, you direct them to Marvin Silver, and we'll talk at the very end about action steps that people could take who are interested in further steps, and also about places you can go for more information. And now I'm going to start to pose some of the questions that have come in from the guests on today's call. One, a high-frequency trader said that a financial transaction tax would put him out of business. And the questioner asks, do we know how many of these people there are? What would be the effect on them? And also, what would be the effect on us as a society if a financial transaction tax actually did put some high-frequency traders out of business? Is that a question that Dean or Damon would like to tackle for starters?
Yeah. you know, it almost certainly would put some high-frequency traders out of business, at least insofar as that's how they define their business. I mean, I'm sure you have a number of banks that have high-frequency sections. The whole bank isn't going to go under. They'd probably shut down their high-frequency section. But high-frequency trading, you know, it's a relatively new story. This is the idea that people are trading, you know, milliseconds. You know, they're using the most sophisticated computers. And you probably would put some of these people out of business, and I literally don't see a downside. I really think of high-speed trading as almost similar to, I shouldn't say almost, as very similar to insider trading, and I'll explain exactly what I mean by that. I'm not just throwing accusations around. What high-speed trading is about is getting in front of major movers. So if they know a big fund, if they know a Vanguard or a CalPERS is about to buy a large amount of General Electric, they know they're about to buy $50 million in General Electric stock, they know that will move the price of General Electric stock up. They're about creating computer programs that will detect this big movement before it takes place. So they're not providing information to the market, they're getting information from the market, and they're basically taking a portion of the profits that would have gone to other traders. It's very similar as if they had someone sitting in Vanguard's office or someone sitting in CalPERS' office and go, hey, I just found out they're going to buy 50 million shares of this stock. I'll tell my buddy and we'll make a fortune on it. That's what they do. So yes, we are going to put some of those people out of business. And I see that as 100% a positive because they're not providing a useful service to the market or the economy. And if we make that less profitable or unprofitable, that's a good thing.
The questioner was also asking how many high-frequency traders there are, or if we have any idea about that.
I'd just really be speculating. I mean, there's a relatively small number of firms that specialize. I'm saying relatively small number. We're talking, you know, dozens. You know, certainly less than 100. How many people are employed by them? You know, we're probably talking a few thousand, not a very large number. Now, some of them get a lot of money, so there's a lot of money there. You know, we certainly have people who are making tens of millions a year doing this, perhaps hundreds of millions, but the absolute number of people involved is almost certainly very small.
Did any of the other speakers want to address the subject of high-frequency trading?
Yeah, this is Damon. Can I just say about this that what Dean has said is correct, and there's a couple of more things, though, to understand about this. Most of the large-scale high-frequency traders, particularly the big firms that engage in it, the big institutional players like Goldman Sachs that do it, they do something called co-location, which means that they pay the stock exchanges to put their computers literally, physically on top of the stock exchange's computer, which means that you get a millisecond or a millimillisecond information advantage. It's literally front-running the market. So it's actually a little worse than what Dean was saying, at least as practiced by the people who play it in a big-time way. There are two positive impacts that would come from closing down high-speed trading, high-frequency trading. The first is that, like any other form of gambling, to engage in this activity, you need a stake. You need money in your pocket because it's not without risk. And all that money in the pockets of high-speed traders is essentially savings that is not being invested in anything that an economist would recognize as an investment. And it would be good for the economy to have that money doing something productive. Secondly, the activities of high-frequency traders, as I think one of Dean's slides suggests, are a source of systemic risk. And they're a source of systemic risk in two ways. They put more volatility into the equities markets, and potentially to the extent that they borrow money to do what they do, they create paths of contagion. To the extent that if there's a break of some kind in the markets, the existence of large volumes of high-frequency trading potentially could destabilize the credit system. And then finally, they do something destructive to our capital markets, which is that the practice of high-frequency trading and co-location creates the accurate impression on the part of all other investors that the game is fundamentally rigged, that our capital markets are not really open to all and are not a level playing field. And that's not good in terms of our ability of our capital markets to do what they're supposed to do, which is turn savings into investment.
Thanks. I wanted to ask if the next slide could be put up, which lists some action steps that people can take. And while it is, I hope, oh, here we go. So as you'll see, there is both a petition, which you can send to your partners, encouraging them to sign it. There's also a link to a fact sheet, and we'll tell you afterwards how you can share the recording of today's seminar. Now, a second question. Doesn't New York State already collect the financial transaction tax, returning the money to the Wall Street firm, the questioner asks. Does anyone know about that?
Yeah, this is Dean. They've had a tax. They did, in fact, used to collect the tax, and they now, I think it was 76 when they stopped collecting it. So it's on the books, and I believe it's set at 0. So no money actually changes hands. But in principle, they do still have the tax on the books, and they could, in principle, raise it. So there's an important point to keep in mind. People who say that, oh, you can never do this. Well, we have done it. We also, I should point out, we still have a very small tax. There's a tax that's used to finance the Securities and Exchange Commission. I should know the exact amount, but somewhere around 1/10,000th of 1%, raises around $800 million a year, which is used to finance the Securities Exchange Commission. But that tax for New York State is still on the books, and presumably it'd be easier if they were to have, some state tax to simply make it a non-zero amount. But they never eliminated the tax.
Here's a related question which maybe David will have some insight about. A questioner says that some folks in Illinois, maybe in other states as well, have been talking about a state-level financial transaction tax. How would this work? How would it work to potentially have a state as well as national tax? Is that too much? Any thoughts on that? David, do you know anything about the Illinois activity?
Yeah, I've spoken with the few folks about this, and I actually sat down with one of the state senators who might be somebody that would help move this if it were to get to a point where we thought it could actually be legislation with Dan Biss. I think the hardest thing about it, look, when we spoke a couple of years ago with Dick Durbin's folks about this at a national level, and what they wanted to do is sort of hide a little bit behind, well, if Europe went, then we'd go, but this drumbeat of fear that says that, well, if you do this here, suddenly all the capital work done in the United States is going to fly overseas, which is simply not true for a variety of reasons that probably Dean and other folks smarter than me could address. But at the state level, there's a little deeper fear, I think, on that, because it's not that difficult, perhaps, maybe, to move some of the CME stuff out of Illinois, although I would suggest that there's an awful lot of investment that's already been done. People like living in Chicago. There's a reason that those markets exist in Chicago. They're certainly not going to run across the state line to Indiana and try to form something in Gary. So I would think that there might be possibilities, but I think that the effort to do this at a national level is probably where it really belongs. It's going to raise more. It's going to fund a wider stream of expenditures and reinvestments in the economy than just at the Illinois level.
Okay, thanks. Another questioner says that the CBO, the Congressional Budget Office, predicted some reduced output and employment in the short term from imposing a transaction tax, while saying that the long-run effect is unclear. The question is, how do you respond to this finding about negative short-term effects? Anybody?
Well, I'll just say, and then everybody, again, can jump in on that. But I think Dean sort of addressed that. I mean, it's a fairly amorphous question. If what the question is that, oh, yes, there might be some Wall Street folks that are going to see reduced incomes or even lose their jobs, that's what you would call the near-term drop in jobs. The long-term being unclear because we're talking about how to raise the money, and nobody has put on the table yet how we're going to spend the $350 billion, or really the $1 trillion if the Ellison bill comes into effect. as we see those things get scored, I think it's a mammoth landslide for what would get input into the economy in terms of jobs by enacting this, than the very, very small amounts of folks who, you know, used to make horses and buggies when the automobile became popular.
Yeah, that's exactly right. And, you know, there have been efforts, the European Commission, since they're, you know, moving along with putting a tax in place possibly as early as next year, but maybe another year down the road, 15. But in any case, they have looked at this carefully, and, you know, the real question is, what do you do with the money? And if it's used as investment, if it's used for an awful lot of purposes, we're going to make the economy more productive. We'll end up as a big job gainer. So, yes, it will certainly lose jobs on Wall Street. And to some extent, that's the point. I mean, you know, these are not the high-speed, high-frequency traders. These people are not anything to the economy. It's like we have people digging holes and filling them up again, because from the standpoint of the economy, that's what they're doing. They're not adding anything to the economy. They're getting rich. They might be getting rich, but they're not. The financial markets, the financial sector is supposed to be about taking savings, translating into investment. That's not what's going on here. So we're going to lose some of these people who are basically, you know, being parasites on the rest of the economy. But we could use this money for lots of purposes, for education, for roads and bridges, our infrastructure. We have a whole set of needs that everyone knows about better than I do. And when you factor that in, it's almost certainly going to be a very, very big job gainer.
I'd like to ask about the historical record. There are people in the industry who are saying that there's an experience in Europe, the Swedish experience, that proves that a financial transaction tax doesn't work. They're also claiming that the Europeans are already having doubts. Damon, is that something you would comment on?
Yeah, I mean, and Dean will want to add, I think. Well, there's three things I think that are relevant to this in terms of, or maybe four that are relevant in this terms of factual stuff. One is that the Swedes did impose during an economic crisis they had in the early 90s, the Swedes did impose a financial transactions tax. And Sweden is I'm sure people know this, Sweden is a small society and a small economy with a small capital market. Very, very heavily integrated in with the European markets. It was relatively easy, and in fact, some financial actors did to move without barely noticing it, move their financial activity to untaxed markets in Europe in response to what the Swedes did. It was also a pretty high tax. I forget the number, but Dean would know. In contrast, when large economies have adopted financial transactions taxes, nothing of the sort has happened. Something that's relatively not very well known is that the United Kingdom has had a stamp tax on initial public offerings. So it's a more limited tax, but actually in certain respects you would think a more easily evaded one for decades, which appears to have had no impact at all on the UK's ability to be an international center of initial public offerings. In addition, Brazil had in the early years of the Lula administration, Brazil had a financial transactions tax that was actually broader than the ones that are being contemplated by the European Union and that have been proposed in Congress, which raised a great deal of money, which had the positive side effect of exposing a lot of tax evasion, of other taxes, leading to increased revenue, and appears to have had no impact on Brazil's financial markets or economy in a negative way, although it was part of a set of measures that led Brazil to have enjoyed perhaps the best economic record of any major economy over the last 10 years. Now, I just want to also add something about revenue estimates here, because I think it's important for people who are listening to understand just how much money we are talking about and what the potential investment implications of this type of money is. The number that we've talked about in this call, the $350 billion over 10 years, right, is really the low end of the revenue estimates involved. And it was done by a body, the Joint Tax Committee, that has to answer to a lot of different political voices here in Washington. When the European Union studied this with a much bigger set of researchers in a much more extensive way, looking at the European Union's proposal, which is different than Harkin DeFazio, but actually it has some similarities to it when you average it all together. They came up with a number for Europe, which if you translate to the United States in terms of the size of our capital markets, was close to $1 trillion over the 10-year budget window. And as Dean has said, and as I think David has said, there's reason to believe that the more aggressive version of the Wall Street speculation tax that's in Congress, Congressman Ellison's bill, would in fact raise dramatically more than $1 trillion. Now these are big numbers, but it's important to understand them in comparison with our nation's need for public investment. And I'll just mention one of those needs, which is infrastructure. The American Society of Civil Engineers says that we've got a $3.2 trillion infrastructure deficit. Right? We need revenue on this scale to be able to maintain the competitiveness of the U.S. economy through public investment. We really don't have any choice if we want our economy to prosper in the future. And the Wall Street speculation tax is probably, in my mind at least, the most effective way to raise this money without having an impact on the larger health of our economy. So I just want to add that to sort of re-emphasize the point that Dean was making.
Yeah, let me just start a couple things adding to that. First off, again, to take the example of UK, it's a little bizarre. We have these arguments that, you couldn't raise the money. The United Kingdom is doing it, and I looked it up recently. That their tax actually goes back over 3 centuries. They first put it in place in 1694. I won't guarantee it's been in place continuously over that period, but through the last 320 years, they've taxed their stock exchange, yet they have one of the largest exchanges in the world. And they raise a lot of money. They raise $30 to $40 billion a year relative to the size of their economy, adjusting it to the size of the U.S. economy, just taxing stocks. They're not taxing the option, futures, credit default, swaps, all the instruments that we would like to see taxed. A couple other points, they say, well, they'll go to other markets. What's striking is almost all the other markets that people invariably list. They go, they'll go to Hong Kong, they'll go to Singapore, they'll go to India, they'll go to China. They all have financial transactions taxes. So if the point is to get away from them, they're not going to do that. Another point to be made in this context, people don't just look at the tax, they look at the total cost. Our cost of trading have plummeted over the last 4 decades. So I was on a panel once with someone from one of the financial firms. They said, you're going to be raising our costs back to where they were in the mid-'90s. Okay, well, we had very vibrant capital markets in the mid-'90s. Why is that a bad thing? Last point that was in the question about how Europe's already backing down. Whether, I'm not up to date. Other people may know better where exactly things stand. But, yes, there is a lot of opposition in Europe. Surprise. The European financial industry isn't any happier about the tax than our friends on Wall Street. So, yes, of course, they aren't backing down because there's been some new evidence produced that shows, it's going to wreck the economy or won't raise money. They're backing down, or I shouldn't say backing down, it's meeting resistance because the firms that will lose money, that are going to have to absorb the cost of this tax, their financial industry is every bit as anxious to preserve their profits as our financial industry, and they're making a big effort to try to prevent this tax from going into effect. That's absolutely right.
Okay, we're going to wrap up with one last question, which will keep us to about an hour from when we started. And there are actually 2 questions that are both address the Ellison bill and the much higher revenues, or the much higher rate, I should say, of the Ellison bill. And I guess I wanted to merge them into one question about the relationship between this tax and public investment, and what is the right level for such a tax. And I want to invite Ben Jones to speak about public investment if you're still with us and have anything to say on that subject.
Yes, and thank you very much. Many of these points have been well made, but I would like to add a few. When you are looking at, from the additional point of view of the next generation, the millennial generation, they are facing a series of deficits, both in terms of the willingness of our country to invest in their education, in their infrastructure, et cetera. And they are always told it's because we're broke, that America's broke. We can't afford to do this. And yet, I think when you listen to this conversation, it's very clear America's not broke. America's rich. We're the richest country in the world, the richest country in the history of the world. The problem is that because we have some pretty dumb tax policies right now, a very small segment of our population is able to hang on to more wealth than is fair and refuse to reinvest it through taxation. Well, that's hurting the country. It's not just hurting the conversation in Washington, D.C. We have a situation now where we literally have bridges falling down. A bridge just fell down in Washington State. We have roads that are literally crumbling. We have construction workers that are sitting idle, and we come up with crazy ideas about building pipelines, which will employ 3,000 people for 6 months, because that's the best we seem to be able to come up with. If we had this kind of revenue on the table, depending on the numbers you look at, you're talking about being able to create literally not thousands of jobs, but ultimately millions of jobs that are productive jobs that let the entrepreneurs, like the small business person you have on the phone call, have customers come in the door. They put money in people's pockets and back in local economies so we can actually grow the economy the right way. Main Street deserves investment. The side streets deserve investment. The back roads deserve investment. And Wall Street should not be able to sit out the worst economic crisis of the Great Depression and spend more money avoiding taxes and more money trying to skew the debate in a negative direction. They should be required, like the rest of us, to help the country out of the situation we're in.
Thank you all. As you can see, there's a slide up about some action steps and ways to get more information. If your screen is like my screen, you can't actually cut and paste or link from it, so we'll try to email to all the participants in the call the same information, and also the way in which you can listen to a recording. And here is another slide with additional resources, so pretty much anything you want to know about the financial transaction tax you should be able to find out. And I just want to thank everyone again, the 4 speakers and the 80 to 100 guests who've been on the line for the last hour, and we'll keep in touch. Thank you.